Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, retirement planning, and everything related to growing your wealth. The Investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers, with over 850,000 reads and 53,000 likes. I've produced over 800 videos with more than 350,000 watch hours as of February 2025. I also focus on regional and global economic trends. Today, we're diving deep into an analyst report on Mapletree Logistics Trust, SGX ticker M44U, the heavyweight in Asia's logistics REIT space. Before we get started, let me set the stage. Mapletree Logistics Trust, or MLT, is a name that pops up in almost every Singaporean investor's REIT watch list. But after its latest quarterly results and a fresh analyst review, is it still a buy? Or should you be cautious? I'll break down the analyst rating, the numbers, the risks, and most importantly, add my own perspective on what matters for you, especially if you invest using CPF or SRS. And if you want to go even deeper, wait till you hear what's available for members at the end of this video. Let's jump in. First, a quick intro. Mapletree Logistics Trust is Singapore's first Asia-focused logistics REIT, managing a sprawling portfolio of 180 properties valued at $13.3 billion across 9 Asian markets. Think warehouses, distribution centers, and logistics hubs in Singapore, Hong Kong, China, Japan, South Korea, Australia, Malaysia, Vietnam, and India. If you've ever shopped online, odds are your package passed through an MLT property somewhere in Asia. But the logistics sector isn't immune to global headwinds. MLT's latest 4Q FY25 results show the challenges. Gross revenue dipped 0.8% year-on-year to $179.6 million, and net property income fell 1.6% to $152.8 million. Distribution per unit, or DPU, dropped 11.6% to 1.955 cents for the quarter. For the full year, DPU was down 10% to 8.053 cents. These numbers were in line with some expectations, but the trend is clear. Growth is stalling, and the pressure is mounting. So, what's the analyst verdict? UOB Kay Hian, one of Singapore's top brokerages, has maintained a hold rating on MLT, trimming their target price from $1.35 to $1.31. That's about a 13% upside from the current price of $1.16. The consensus among other major banks is more optimistic, with target prices averaging $1.60. But today we're focusing on the more cautious side of the street. Let's break down the analyst's reasoning, starting with the financials. MLT's revenue decline was driven mainly by its China portfolio, which has been a persistent drag. Rental reversions in China were negative 9.4%. This quarter, meaning rents on renewed leases were almost 10% lower than before. That's actually a slight improvement from the previous quarter's negative 10.2%, but it's still a red flag. Weakness in the Chinese economy and ongoing trade tensions are hurting demand for warehouse space, especially in export-driven regions. Outside China, the picture is brighter. Rental reversions were positive in every other market. Japan saw a whopping 15.7% uplift. Though that was skewed by a very old lease renewal, Singapore posted a healthy 7% gain, and South Korea managed 4.7%. If you strip out China, portfolio-wide rental reversion was a solid 6.9%. That's a sign that MLT's core markets, especially those serving local consumption, are still resilient. Occupancy remains strong at 96.2%, barely changed from last quarter. The tenant base is highly diversified, with over 85% of revenue coming from businesses serving domestic markets rather than exports. This is crucial because it insulates MLT from the worst of global trade shocks. But it's not a total shield. About 15% of revenue is still exposed to export demand, and that's where the volatility creeps in. Let's talk about costs. Borrowing costs rose 4% year-on-year as interest rates stayed high. MLT has hedged 81% of its debt into fixed rates, with an average debt maturity of 3.8 years. That's prudent, but every 25 basis point increase in rates still chips away at distributable income. Management has also hedged 75% of next year's income into Singapore dollars, reducing currency risk, but the strong SGD still hurt reported results from Australia, Korea, and China. If you're wondering about the balance sheet, MLT's aggregate leverage is 40.7%, up slightly from last quarter, but well within the MS regulatory limit of 50%. The interest cover ratio is 2.9 times, comfortably above the minimum requirement. MLT's net asset value per unit is $1.31, matching the analyst's target price. So, from a financial health perspective, MLT remains robust. Now, let's zoom out and look at the bigger picture: growth drivers and risks. On the growth side, MLT continues to rejuvenate its portfolio. In the past year, it completed 3 accretive acquisitions in Malaysia and Vietnam, targeting areas with rising consumption and e-commerce demand. These new assets are fully occupied and deliver initial yields above 5.7%. At the same time, MLT has been actively divesting older, less efficient properties, 14 in the last year alone, at an average 17% premium to valuation. This capital recycling helps keep the portfolio modern and competitive. There's also a strong sustainability angle. Over half of MLT's portfolio is now green certified, and the trust has ramped up its solar energy capacity to 71.1 megawatts, the largest among Singapore REITs. Green financing now makes up nearly a quarter of total borrowings. For investors who care about ESG, MLT is ticking a lot of boxes. But what about the risks? The analyst is clear. The biggest clouds on the horizon are China's economic slowdown and the risk of a protracted trade war. 7 consecutive quarters of negative rental reversions in China have taken a toll, and management expects this weakness to persist for at least another year. If trade tensions escalate further, demand for warehouse space could fall, pushing occupancy and rents down even more. Currency risk is another factor. The strong Singapore dollar has already hurt reported results from overseas assets, and while hedging helps, it can't eliminate the impact entirely. Higher interest rates are also squeezing margins, though there's hope that rates may ease later this year. Valuation is a tricky subject. As 1016, MLT is trading at about 0.89 times book value and offers a forward yield of around 6.8%. That's attractive compared to fixed deposits or government bonds, especially if you believe rates will fall and REITs will rebound. But the analyst's target price of $1.31 suggests only modest upside, and the consensus target of $1.62 looks optimistic unless China turns around quickly. Let's add some historical context. MLT has long been a darling of the REIT sector, known for its steady DPU growth and defensive qualities. But the past year has been a wake-up call. DPU has now declined for 2 consecutive years, reflecting both operational headwinds and management's conservative approach, retaining some divestment gains to build financial flexibility. Previous analyst calls were more bullish, with target prices as high as $1.75 earlier this year. The recent downward revisions reflect a more cautious outlook, especially on China. So, do I agree with the analyst's hold rating? Here's my take. MLT is still one of the best-run logistics REITs in Asia. Its diversified portfolio, strong tenant base, and prudent capital management give it resilience that many peers lack. The focus on domestic consumption markets is a big plus, especially in a world where global trade is volatile. The sustainability push is also commendable and could attract more institutional capital over time. But I can't ignore the headwinds. China's weakness isn't going away soon, and the risk of further trade disruptions is real. While MLT's other markets are holding up, the drag from China will likely cap DPU growth for at least another year. The current yield is attractive, but without a clear catalyst for a rebound, I think the analyst's cautious stance is justified. That said, I see some overlooked opportunities. If you're a long-term investor, the current price offers a chance to accumulate units at a discount to book value and then lock in a solid yield. If interest rates start to fall, as many expect, REITs like MLT could see a strong recovery in both price and DPU. And with Singapore's CPF and SRS schemes, you can enjoy tax-efficient returns, especially since REIT distributions are tax-free for individuals and only 50% taxable for SRS withdrawals. For those using SRS, remember, leaving your funds in cash earns almost nothing, while a well-chosen REIT like MLT can help your retirement savings grow and keep up with inflation. Let's tie this back to sector trends. Singapore REITs have had a rough ride lately, with volatility driven by global uncertainty, trade tensions, and interest rate swings. Logistics REITs remain among the most resilient, thanks to the rise of e-commerce and the shift towards domestic supply chains. But those with heavy China exposure like MLT face extra risks. Investors should focus on REITs with strong fundamentals, low gearing, and sustainable distributions. If you're finding this in-depth analysis valuable, imagine the level of detail you'll get with our daily premium content. For just $1 a month, you can become a member and unlock exclusive insights, deeper dives, and more to help you navigate the Singaporean investment landscape. Don't miss out on this opportunity to level up your investing journey. The link to join is in the description below. To sum up, here are the key takeaways. If you're finding this in-depth analysis valuable, imagine the level of detail you'll get with our daily premium content. For just $1 a month, you can become a member and unlock exclusive insights, deeper dives, and more to help you navigate the Mapletree Logistics Trust remains a solid defensive play in the logistics REIT space, with a diversified portfolio and strong management. However, persistent weakness in China and macroeconomic uncertainty are weighing on growth. The Analyst hold rating and $1.31 target price reflect a realistic view of near-term risks and limited upside. For long-term, yield-focused investors, especially those using CPF or SRS MLT, still deserves a place on your watch list. But don't expect fireworks until the China drag eases or global conditions improve. My overall outlook, cautious but constructive. MLT is a classic sleep well at night REIT, but patience is needed. If you're looking for explosive growth, you might want to look elsewhere for now. But if you value steady income, strong governance, and exposure to Asia's long-term consumption trends, MLT is worth a closer look, especially at current prices. Want to dive even deeper and get exclusive investing insights delivered to you every single day? For just $1 a month, you can become a premium member and unlock a wealth of additional content, including stock analysis, daily market analysis, early insights into promising trends, deeper dives into specific investment strategies, analysis, and perspectives that will give you a real edge in growing your wealth. Think of it as your daily dose of financial fuel. Thanks for watching. If you enjoyed this deep dive, don't forget to like, subscribe, and consider joining as a member for even more exclusive content. Until next time, I'm Iggy, helping you invest smarter, one iguana-sized bite at a time.